So the anticipated inflation number just came in and bam, consumer prices rose 8.5% in July, less than expected as inflation pressures ease a little bit down to 8.5. Wait a second, this is August of last year. So last year at this time, we were at 8.5% inflation. Where are we today? Well, we're all the way down to 3.2. So for those out there saying, hey, the Federal Reserve needs to keep putting their gas on the pedal, increasing rates, I think it's starting to work, folks, if you just give it a little time that I've been expecting. So how's this affecting the markets right now? And why do we focus so much on the CPI and everything else? Well, basically, the CPI is a gauge that the Federal Reserve watches to see what inflation's doing. Well, again, last year at this time, we were over double what this number is. It came in today. So we're on a good trajectory on where the Fed's going. So today, though, you're going to see the gauge came in at 3.2%. The last reading was 3%. So now it's ticking up. Is that spooking the markets? Well, not really, because last month when the number came out, we're all like, how did that number come in so low? There's probably going to be some revisions that come in, but the 3.2 is actually below all the analysts' expectations. Okay, so the other thing we watch is what is month over month? Month over month came in right as expected. So let's get over to the economic data so we can basically pinpoint the data that we just got today, and it's nothing but good news basically for what the Fed's looking at. So let's break it down. What the Federal Reserve's two mandates is price stability, which is AKA inflation. So what's going on with inflation? And the next thing is full employment in the economy. Well, right now, the Federal Reserve keeps saying, well, we need more and more people to lose their jobs so we can drive down inflation, basically help people not spend as much if they lost their job. So what you're seeing right here is all this is playing right in line with the Federal Reserve is wanting to happen. So let's go break this down. The core CPI month over month, as we talk about all the time, core means they stripped out food and energy because I don't know about you guys, but gas prices again, I filled up last night, thank God, because on my way in this morning, gas prices went up once again. So we're starting to see the fuel or energy or commodities prices increasing. And that's why in the core inflation, they strip out food and energy because it is so volatile even week after week. So if you plug in these numbers, it can really skew the numbers on a monthly basis. So month over month, the CPI numbers came in, core inflation came in right in line. Okay, the next reading might be a little bit hot because of oil prices and commodities, but we're going to worry about today. Let tomorrow worry about itself. And then you come into the CPI month over month. It came in right as expected as well. So that's fantastic news. Then here's kind of the anomaly, but let's break this down. Last reading came in at 3%, just like I said. But analysts were saying that there's an anomaly there. There's something there. There's revisions going to come in. So we're expecting this reading to come in at 3.3. Came in at 3.2. So a tenth better than everybody was predicting. Good news there. Now let's get over to the initial jobless claims. How many people filed first-time claims? Again, the Federal Reserve wants this number to go up. They want more people to basically lose their jobs. So it went from 227 previous reading. It was supposed to come in at 230, came in at 248,000. A lot more people are getting laid off on their jobs. Well, that might spook the economy, but that's helping the economy kind of in general when it comes to the Federal Reserve. Now, it's not over yet this week, guys. We still have tomorrow's PPI number. Now, the numbers that we got today are consumer inflation. The numbers that we're going to get tomorrow is producer inflation. How much inflation is going up at the producer level? So if that's, going way up, we know eventually that number is going to creep over to the consumer piece of the equation. So we're going to watch tomorrow, but it usually doesn't have as big an effect on the markets as the CPI number that comes out daily. So I want to give you guys some information. If you focus on the stock exchange, what the markets are telling us about, interest rates and so forth. A lot of people are just sitting on the sidelines waiting for the Fed to kind of finally come in and say, okay, we're going to start cutting rates, or at least the pause is in for good. But I want to give you some insight here. This is what a lot of people don't focus on as well. Let's look at where the S&P is. If you see that right here, here's the S&P 500. This is what people monitor when they're monitoring the stock market. A lot of times you don't monitor the Dow because it just has specific Dow stocks. But the S&P 500 is a basket of 500 different companies in all facets of the economy. The last Fed meeting, or the last CPI reading that came out, was basically down here. Let's go through that. July 11th of 2023, the last when the last CPI number came out. Let's look where the S&P was at that time. 4,472. So let's see where it closed today or closed yesterday. 4,467, basically completely flat. So this is telling us the markets are waiting for the Federal Reserve to kind of give us some signals. Are you going to cut, or at least are you going to just permanently take your foot off the pedal and stop saying it's going to be completely data dependent, which I get it. But what they're going to have to do is give the markets some direction. They don't want to do that. They love the flat stock market. They love more and more people getting laid off. And they love the fact that the inflation numbers are coming down again from where we were at 8.5% to where we came in today at 3.2%. So now let's look at what's the probability that the Federal Reserve will raise rates at the next meeting. So you go through here, we go to the Chicago Mercantile Exchange, the Fed Watch tool. Now, a lot of people watch this, some people don't. I focus in on this because gives me the probabilities of what's going to happen. Next meeting comes in 41 days from now. If you go through here, what exactly is this? Well, it is the likelihood the Federal Reserve will change the target rate at the upcoming FOMC meeting. Well, when is that meeting? Well, if you see down through here, the next meeting is on 9/20 of 2023. If I get my head out of the way right now, you're going to see the probabilities are here. The probabilities right now, well, where we are right now on the federal funds rate is 5.25 to 5.5. So the probabilities right now are 90%, over 90% that they're going to stay right there. And there's no projections right through here that they're going to increase rates at all. So then if you go over to, a lot of people talk about the dot plot. Well, let's really focus in on the dot plot. What this tells us is where the Federal Reserve participants, you see right through here, where they're saying rates should be, the federal funds rate. Okay, you're seeing right now we're about 5.5 to 5.75 is where they're telling us. So there might be one more increase by the end of the year. But let's just scan out, because the markets, especially if you're looking to buy a house, you want to focus in on, what's the next 12 months, 24 months, what do interest rates look like in the future? Might give you an opportunity to buy now and refinance then. Well, next year, they're saying right through here, the consensus is telling us it's going to be about 4.25. Okay, 4.25. Where are we now? 5.5. So that means even the FOMC participants are expecting interest rates to go down 1.25% within the next 12 months. Fantastic news for everybody. So now let's get over to one other caption I have. I'm going to put out a house hacking video. What is house hacking? How can you use it to buy a multi-unit building to basically make you living in a property for free? So I'm going to put out a video within the next 48 hours on that. Please check it out. I think you're going to find very much, some interest in there, and you're going to find some content in there that like, I didn't know that. So with this data coming in, what in the world are the bond markets doing? So we focus in on a daily basis is what the mortgage bonds are doing, because this is going to tell us exactly what's happening with mortgage rates. It is all over the board right now. When the number came in, this spiked up to 20, then it came back down to 2, then it's, where is it now? Well, you can see right here, if you squint, it is up 9 ticks. What that means to rates is rates aren't really going to do anything right now. The market's going to absorb this data. They're going to really dive into it, focus in what sections of it are hot, what are coming down, what's the shelter numbers looking like, and all that stuff. So I'll post tomorrow's a video. When I post the PPI number report in the morning, I'll kind of dissect a little bit more of what the CPI numbers, diving into those numbers, look like to maybe give you some context at that point. But right now, basically, the markets are flat, which I'm okay with, because if this number came in bad, if this number came in at 3.5 or 6 or 7 or whatever, we would have saw stocks plummet and mortgage rates spike. So this is good news for today, folks. Let's get over to where mortgage rates are today. Well, this is where they were yesterday, how they closed the end of the day. These are the top 6 products people use when they're buying or refinancing a home. These are rates published by Mortgage News Daily on a daily basis. What this consensus is how did they come up with this rate? Well, what they did is they surveyed mortgage lenders all over the country and asked them, if you had a borrower, a first-time home buyer buying a primary house, and it's a single family home, those 3 criterias, and they had a 740 credit score, and they're putting down 20%. Okay, all those facets. If that's you, that's probably most likely where your rate's going to be. But if you don't have that criteria, let's say you have a lower credit score, rate's going to be a little bit higher. You're not putting down as much money, rate's going to be a little bit higher. This is probably the best rates that you're going to get in today's market. So if you're searching around, please use us. What do we do? What do I do? Who am I? Well, my name is Dan Free. I do the mortgage update every day to inform you guys what's going on with the economy, economics, and especially real estate. So if you're out there and you're like, hey, Dan, I really would like to get into a house this year. Maybe it's my first investment property. How do I house hack? Can I get into a property and use rentals to basically pay my rent, pay my mortgage for me to make it rent free? Or maybe you're out there looking to refinance. You have a ton of equity in your house, but you got multiple credit cards at 25% interest rate, and you're like, I'd really like to pay those off with a low interest rate loan. We can help you there as well. So if you want to reach out to us, get us directly. This is the best way to reach us. 844-775-LOAN. 844-775-5626. Or if you're out there and you say, Dan, I can't call you during the day. Well, if you hit the apply now button, what's going to happen now? We changed this recently. We're going to set up, or we're going to offer you a calendar event schedule where you can schedule a one-on-one appointment with me or one of my mortgage advisors to inform you guys what you can qualify. And we'll go through all the scenarios to help make sure you make this transition from renting to home ownership as easy as possible. So thank you so much for watching today. I'm going to ask you one main thing today, if you would. Please, if you haven't yet, click the subscribe button down below. It helps me get found through more and more YouTubers out there to help me educate those out there that are looking to buy a house in 2023. Thanks so much for watching, guys. I appreciate it. God bless. See you tomorrow. Bye-bye.